Hey everyone, we've just wrapped up another crazy week in the markets. So, what I'm going to do in this video is go day by day, just talking about some of the key earnings reports that I was interested in going into the week, looking at what kind of performance the companies reported, how their stocks reacted, and I'm just going to be able to go through kind of the top couple from each day. If there's any that I don't touch on that you're interested in, let me know in the comments. I'll be sure to share my thoughts on any of these names. But I'm really just looking at companies and industries I'm interested in or that may give macroeconomic indicators of where the economy is going to be going from here. So let's jump into things. On Monday, the two stocks that I was interested in was Activision Blizzard, since I have a stake in Microsoft, which has agreed to acquire the company, as well as Pinterest, just for general online digital advertising sensing. So first on Activision, the stock was up almost 4% on the week, still trading 25-ish% below the buy price that Microsoft's agreed to pay. There's a lot of regulatory hurdles in the US and in Europe, so some pessimism on if the deal will eventually close. And obviously, if it doesn't, this company's trading at a much richer PE since it really hasn't fallen off with the rest of gaming since Microsoft kind of bought it at the high or agreed the buy price at the high. Going into their earnings, um, honestly, when we look at the calendar year, I know there's been a slowdown in gaming, but they're really not anything to write home about. About a 20% dip on revenue from 21 to 22. EPS at $2 on a GAAP basis, 250 on a non-GAAP basis, both down, 30-40% versus prior year. So even on a non-GAAP basis here at 250, if we're buying it for $95, that's buying this company for 38 times earnings. So definitely an expensive multiple given 2022 performance that Microsoft is paying for this business if the deal does happen to close. Interesting that the stock went up. I think one of the reasons why it kind of held despite the numbers it put up was a couple things. It looked like, in terms of Q4 at least, this was calendar year, but Q4 they did grow revenue a bit, and their EPS run rate is higher than it was on the year. With that being said, Q4 is probably, with the holidays, a very large season for Activision in terms of profits. So take the last point with a grain of salt there. The other thing is they allude to Microsoft a lot in this earnings report. They talk a lot, even in their highlights, of just working towards merging with Microsoft, fully committed to the Microsoft deal, stuff like that. So maybe their optimism on the deal made investors think that, hey, maybe there is a price that this thing does get bought out throughout 2023 at 95 a share, and you get an automatic 25% return on investment for holding the name for under a year. So maybe some people moving out worried about the longer term valuation of the company, while others may be moving in being like, hey, I may be able to get a quick trade here and make a pretty good return. On to the next stock. Pinterest here reported numbers and went down pretty dramatically. And it's interesting. It looks like they jumped initially on the Meta earnings, which were pretty strong relative to expectation, and then dipped with the rest of big tech, and now have just dipped even more this past week when we saw their actual numbers. I won't get into this too much, but just for a company that's not really overly profitable and really needs to scale and grow to become a player in digital advertising, to grow revenues 4% globally, to have very mute monthly active users, average revenue per user at flat essentially. Um, you know, all in all, their top line key performance indicators are up low single digits, but their costs are up 20, 30, 40%. So company that their economics have deteriorated over the quarter versus year ago, and they're a company that isn't a huge cash cow and profit generator like some other big digital advertising companies who can afford to take cyclical hits, right? So I'm not surprised to see this name get crunched. I think if the regulatory environment wasn't as harsh, you'd see, other companies sniffing around to tuck in Pinterest into their companies as an acquisition. But I think people are just scared and don't think that the deals would go through, given how reluctant the government is to let these deals pass. Going on to Tuesday, a couple of the big names that I was looking at was Chipotle, just for a sense of how quick service restaurants are doing. I also thought Royal Caribbean would be an interesting company to look at. Not overly interested in either of these companies for very different reasons, but just to get a good sense of how the economy is doing. The first one with Chipotle, Chipotle is down almost 7% on the week, but they did open a lot of new locations. It's just they did miss revenue and same store sales targets that most of the street had. And this is just an example of, a great business with sky high expectations that just slightly missed. And when you're priced for perfection, slightly missing expectations will put your stock down a lot, because you're priced in to be a company that at least hits that minimum, but hopefully exceeds and continues to accelerate ahead of general consensus. There's lots of investors who are bidding the company up to these valuations because they think that Wall Street or general investors are understating the growth rate. So when numbers come in below the expected growth rate, you see weeks like this. For long-term investors, I don't think it's a big deal. You can look at long-term results here, just phenomenal. So we'll see how this company continues to play out. I think they opened like over 100 doors, incremental net businesses in terms of new locations over the quarter. So as they keep rolling out new locations, we can see a lot of growth ahead for this company. But in terms of this week, it was a losing week based off of the results. Going into Royal Caribbean, stock price on the week is up about 5%. When we look at their numbers, they lost money in the quarter again, shocker. But perhaps one of the reasons the company's stock went up is, despite guiding for about, let's call it $1.50 to $1 miss in the first quarter, they think they're going to have EPS of $3 to $3.50 on the year. So if you're going to lose $1 in the first quarter and then have $3 to $3.50 for the rest of the year, that means that for next year they're going to be trading at about 20 to low 20 times. But even if they didn't make any money in the first quarter in 2024 and you just take out the losing year, then you're kind of trading at 14 times, 13 to 14 times 2024. Now, I still think these valuations are rich. Maybe there's more upside in 2024 on top of just taking out the losing quarter. But I remember the cruise companies back in 2018, 2019 were trading at 11, 12 times earnings. So I don't know why I'd pay for the hope that they can get back there in a number of years. So I still think this isn't one that I touch. But interesting to see that it's starting to get some momentum here. But hopefully they can start making some money. I feel really bad for this industry. The other thing they mentioned, I'm not going to find it in the report, but they alluded to having some pricing power, taking out the requirement or the ability to have full refunds up until the day before, and being able to get money up front from consumers because there's more demand. Also alluded to some pricing they're taking across their fleet, which bodes well for just their ability to deliver that EPS this year and going forward. So we'll keep a close eye on the space, but I still don't think the company is cheap enough given where their 2023 and implied 2024 earnings are going to be. So I'm staying away from this one. Going on to Wednesday, which I think was probably the most exciting day of the week. And there's a lot of ones here we can get into, but I really want to focus on the first two here, Uber and Disney. Going into Disney first, I can do an hour video on Disney alone. Lots of stuff's going on. I'd say, generally speaking, the performance in terms of revenue and EPS on the company, I'd say it did like in line to maybe slightly above expectations. But what really propelled the stock price on the day of the earnings here, about 8%, um, the day of and the day before combined, was lots of the strategic announcements that they made that I think investors really liked. Bob Iger came out, did a big media tour essentially on Yahoo, on CNBC, and the general sentiment was um, we're going to continue to make streaming profitable by the end of 2024. So didn't go back on that. Also confirmed that they do not plan on selling ESPN, which I think lots of investors didn't want them to do. Also mentioned that they are going to be reinstating the dividend by the end of the year. Once again, lots of investors like to hear that, and that they're going to start focusing on redeploying capital to shareholders. And then lastly, one of the biggest pivots was the notion that they would be very interested, and he didn't say it like this directly, but very open to selling Hulu to Comcast instead of buying it in 2024. Buying Hulu would probably be a $10 billion cost. They do not have the cash, they do not have the balance sheet to do that. So it would either dilute shareholders further or make their balance sheet even worse. And on the other side of the coin, if they sold it to Comcast for $20 billion, that would really help their balance sheet, really help their cash position to pour fuel on other ambitions that they have on the company. So I think that's probably the better way to go about it. Maybe it's a third party that they bring into the mix to start a bidding war, but I think the street really liked that. Now that was offset obviously by Nelson Peltz really liking what he was hearing on that earnings call, and I think he cashed out near the top. He took his 20 to 30% gain, said that Bob Iger mentioned lots of the things that he wanted to implement in terms of the restructuring, in terms of the Hulu stake, in terms of the dividend. So he didn't think there was enough to squeeze out in terms of things he would change, and he walked away. And lots of investors really wanted him to come in, keep the board accountable, and really change things to a greater extent. And that's why after the stock went up behind those announcements and sentiment by Iger, it went right back down. Still up 20%, 25% over the last, probably month or year to date, let's call it. Yeah, year to date, 20%. But a bit of a wash on the week given all of the moving parts involved. On Uber, Uber had an interesting week. Overall, very wavy as well. Went up a lot during the earnings report, down after, netted out to plus 2%. Overall, I don't know the company too well in terms of expectations, but the numbers look pretty darn good. Grew really well across the board in terms of revenue, up 19%, driven by mobility, no pun intended. That's gross booking volume. Revenue was up even more. Take rates were up significantly on mobility, but also on delivery as well. And then EBITDA and their initial gauge of profitability was up a lot as well. Delivery specifically went from essentially breaking even to starting to become a real driver of EBITDA. So hopefully that transitions into cash flow. There's lots of adjustments and other things in here, but generally I think the results boded pretty well to the scalability of these businesses and the structural economics of delivery as a whole. So I think they gained some momentum this week on this earnings report. Hopefully they can, continue to build on it. Going into Thursday was a huge day. We'll talk about some of these names. We want to talk about PepsiCo, Lyft in contrast to Uber, Expedia as well. So we'll just get into a couple of these. We'll start off with Pepsi. Pepsi reported, shocker, another really strong quarter. Seems like every year and every quarter, this company just delivers, and that's why their stock price is where it is. To look at it over a longer period of time, just steadily going up, increasing the dividend 10% a year, paying out 2 to 3% of shareholders, on top of delivering 10% of capital appreciation. Just a really, really good performance by this company. In terms of their Q4 earnings, in light of a weakening consumer, some debatably discretionary products, increasing inflation in costly goods, increased freight costs, this company continues to deliver EPS growth of 10 and 11% on the quarter and the year. So double-digit EPS growth. Increased the dividend 10% more for 2023. Just phenomenal revenue growth of 11% in the fourth quarter, accelerated from earlier in the year, which was already good. So this business is just being run really well, and their stock price is being rewarded for it. It does trade at 26, 27 times. Lots of consumer products companies are trading at these valuations with a much more choppy track record than PepsiCo. So honestly, I know it's expensive. I personally don't own it here, but I understand people who do, relative to some of the other companies I won't get into that are in the space trading at these levels. On to Lyft. So Uber performed pretty well, riding the wave of mobility coming back, making delivery more profitable. Lyft, on the other hand, despite the market being up, and especially more speculative tech companies bouncing back, Lyft is down on the year and down huge on the week on their earnings report. One thing I found interesting is an analyst called it a top 3 worst call out of the thousands they've listened to over the last number of years. Some playful wording here. Said management is trying to play darts blindfolded with the expense structure going forward, and gave EBITDA outlook, which was a debacle for the ages. I think the general sentiment here is there was an expectation that ride companies were going to really have a wave of demand and drive a lot of growth and profitability this quarter. And we saw it from Uber, and we expected to see it from Lyft, and we just did not see any sign of it from Lyft. So it's a huge disconnect, whether it's like operational issues or whatever it may be. This quarter was just an acceleration in the gap between these two businesses and business models, and really starts asking questions. What's the future of Lyft's business? Not making money, no sign to make money, not growing at the same pace, probably losing share, not in delivery, under 4 billion market cap. Really don't know what the future holds. Lots of people are saying this may be, positioning Lyft as a company that's just going to get taken over and taken out by either a big tech company or a delivery company like DoorDash. Not sure, but just an abysmal quarter. Happy I'm not in this one. Hopefully none of you guys are or were for this week. Down almost 40%. Going into some other names, Yum, like on the other side of the coin versus Chipotle, performed pretty well this week. This is one of those ones that they posted good numbers. I believe EPS was up like 20%, 15 to 20% versus last year. So really strong growth. Probably not sustainable growth rate at 15 to 20%, but still outperformed expectations there. But trading at a really rich valuation for a quick service restaurant, a developed quick service restaurant. Not sure how much incremental big growth opportunities they have on their core business. So this is an example of one that's like, hey, would I rather have Pepsi than Yum trading at 27, 28 times? Yeah, I would. So great business. They performed well, but I think there's better options in these multiple ranges, in my opinion. On to Expedia. So Expedia is one of those companies that trades pretty rich for what it is, and I didn't think their earnings were too bad. I took a couple looks at their earnings reports. Here's another summary. They missed their consensus revenue by 3.5 points. Still grew gross bookings 17%, and just cratered on some general negative sentiment in bookings across the sector of travel, but just also because of their slight miss there on top line. So this is just an example similar to Chipotle. When you have a company that is expecting to outperform and grow really well, whether that's because the base was crappy or whatever it may be, and they come in under, and they don't have a valuation or a price to earnings to really back it, you can kind of see the floor fall under the stock a bit, and that's what you saw here on Expedia. So this is an interesting one in the travel space, not one that I'm in, but I am in a couple other travel stocks. So, um, it will be interesting to see next week if the results here flood into the earnings of some of those other companies. And then lastly, going into Friday, the only stock I own here on Friday was Fortis, pretty boring regulated utility company, and they ended up beating their annual earnings estimates. So up 3% on the news. I think there was some concern that inflationary pressure may hurt the business, uh, but overall delivered 7% EPS growth. So with this kind of company, it's really limited downside because of the regulated nature of the business. So getting a 7% EPS bump in a year that had challenges on cost inputs and cost of development and stuff like that. Um, Pretty good number. You're never going to get like a 20% EPS uh, growth in a company like this, but you're also probably never going to get it the other way either. So, from a risk adjusted return standpoint, I'll take 7% EPS growth all day. So, boring company, not expecting much from it, but I'll take my 4% dividend. I'll take my annual dividend increase, and I'll definitely take 7% EPS growth to help fuel those things this time around. So, yeah, guys, that's kind of my quick look into some of the key companies that reported this week and my thoughts on them. If you like this type of content, please subscribe to the channel, like the video. Let me know in the comments what you think of any of these earnings or any other companies that reported this week um, that you have an opinion on. And I'll see you guys in the next one.